Over the last couple of months, the world of investing and stock markets has been on a bit of a wild ride, and after Trump announced sweeping tariffs on the 2nd of April this year, we've seen large declines in the stock markets in the US, Europe and Asia. Since then, the stock markets have staged a recovery, but the outlook for 2025 remains uncertain, and the financial markets are expected to continue to be volatile, at least in the short term. In this video, I'm going to cover how to navigate and invest in 2025, looking at when to invest, what to invest in, and the key principles that I use when investing. So let's start with what's happened in the financial markets so far this year. In the US, for the S&P 500, we've seen a decline by 18.9% from the high point on the 19th of February, and then a recovery back to around the level just before Trump announced tariffs on the 2nd of April. And we've seen similar declines and bounces back in the major stock markets in Europe and Asia too. What the S&P 500 experienced is called a market correction, which is a drop of between 10 and 20%. And these are actually very common. It's happened in 47% of years since 1980. Every so often we have a big drop, a bear market, which is a decline of 20% or more. And since 1929, we've had 26 bear markets. Although Trump's tariffs may have been a shock, we've seen much larger stock market crashes in the past. We had a 49% decline from the dot-com bubble bursting between 2000 and 2002, a 57% decline from the 2008 global financial crisis, and a 34% decline from the COVID pandemic. The reality is that if you're planning to invest for the next 30 years until you retire or as you continue into retirement, then based on history, you're likely to experience another 7 bear markets. We need to be comfortable when investing that market corrections and even bear markets and crashes are common and all part of the life cycle of the stock market. Even within a single year, we can see big swings. For example, last year, we had an 8% decline on the S&P 500, but we finished the year with a 23% gain. So given the market volatility, is now the right time to invest? Well, financial markets like certainty. And right now, with tariffs being announced, paused, removed for certain goods, and basically changing regularly, it's causing confusion, and we're likely to see markets remain volatile, at least in the short term, going up with daily good news stories and going back down again with bad news stories. Some people will look to buy the dip after bad news and then sell again after good news and go through this cycle over the coming months and across the year. But it's very hard to time the market and come out on top, and there are so many different views on what's going to happen next. But no one truly knows what the stock market will do. There have been some positive developments over the last couple of weeks, with the US and UK agreeing terms to a trade deal and the US and China agreeing to reduce tariffs during the pause period. But no deal has been signed yet, and we've still got some key moments to come in 2025, which could swing the stock markets one way or the other. In July, the tariff pause will come to an end for the majority of markets, and the same for China in August, and we'll see the outcome of whether the major trading markets have agreed deals with the US or not. There's some key data points that we need to see. For example, what happens to GDP figures, i.e. are the economies of the US, Europe and Asia growing, or are they heading into a recession? Is inflation increasing or decreasing? And are the central banks, such as the Federal Reserve or the Bank of England, making decisions to cut interest rates? And then ultimately how all of this impacts corporate company earnings. So as you can see, there are lots of different factors which could create either good or bad news stories and will impact the direction that the stock market goes in. That's why it's so hard to predict in the short term. But with investing, you need to step back. Despite all of the market dips and crashes that we've seen, the S&P 500 has still delivered an average annual rate of return of 10.2% since 1957. With all the noise and uncertainty happening right now, instead of sitting on the sidelines trying to time the market, it's better to keep consistently investing to capture the market returns. That way you average out whether the market falls again later in 2025 or whether it goes up. Data also shows us this. Between 1994 and 2023, although the S&P 500 averaged a rate of return of over 10%, the average investor buying an S&P 500 index fund only averaged 8% return. So that means if you had invested $100,000 at the start of the period, you would have ended up with over $1 million. But that's still $800,000 less than if you had stayed fully invested for the full period. The reason the average investor achieve less returns is because they react to news and go in and out of the market, and this tends to be a bad approach when capturing the long-term gains of a stock market going up over time. Vanguard did a study that found the chances of you underperforming the stock market returns if you switch to cash for 3 months is 61%, and then for 6 months is 72%, and for 12 months is 79%. Vanguard also found that the best and worst trading days happen close together, and that 13 of the best 20 trading days occurred in years with negative returns. So if you're out of the stock market sitting on the sidelines in cash, then you're going to miss out on these gains. So if consistently investing is the best way to capture market returns for the average person who invests, the next thing to talk about is what to invest in. There are loads of different options, whether you're buying individual shares, index funds or ETFs. If you're in the UK, the tax efficient way to invest is via a stocks and shares ISA or a self-invested pension, a SIP. And if you're in the US, you can also do this via your 401k or a Roth IRA. When considering what to buy, I normally view buying individual company stocks with a shorter time horizon to manage risk. Tech stocks like Nvidia and Palantir have seen enormous growth recently, but history has shown us that doesn't always last. Cisco is a very relevant example of this. Between January 1995 and March 2000, Cisco's share price went from $2 to $79, making it the largest company on the planet at the time. But when the dot-com bubble burst, Cisco's share price fell by 89%. When buying individual company shares, you can get huge reward, but you also take on higher risk. What if a competitor comes along and offers more value to customers so they switch to them? Or the management team commits fraud, like in the example of Enron? If we look at the top 10 companies on the S&P 500 back in 2000, out of all of the companies, only Microsoft were also in the top 10 in 2024. So knowing which company is the right one and is going to grow over the next 5, 10, 20 years is a really hard thing to do. Investing in index funds like the S&P 500, the FTSE 100 or MSCI World Funds enables you to do this, as although companies change over time, the bigger stocks are part of the index funds. So by buying an index fund, you're buying a diverse mix of companies, which helps to dilute your risk. There are a few key principles that I use to decide what to invest in, how to invest and when to invest. The first is to set clear investment objectives, as ultimately what's the right investment for you really depends on your investment time horizon. I invest using both a stocks and shares ISA and also a self-invested pension, and my objectives and appetite for risk are different for these two accounts, and therefore my approach is also different. For my self-invested pension, I have a long-term objective of around 25 to 30 years, whereas for my stocks and shares ISA, I have a mid to long-term objective, as I want to be able to use some of the gains from my investments to cover large expenses which I can enjoy now, for example, moving home and paying for a wedding. So the way that I've approached it is that I focus on having index funds for my pension, and then I have a mix of individual company shares and index funds for my stocks and shares ISA. The second principle that I use is to stick to a consistent investment strategy. I pound cost average, or the other term for this is dollar cost averaging. If you're not familiar with the concept, it's simply setting a fixed budget that you invest every week, month or quarter, and you consistently invest that money into stocks that you previously picked, no matter what the price is or the stage in the market cycle. I don't try to time the market, buying and selling and going in and out of the market all the time, and I try to avoid the media frenzy and noise which can artificially pump stock prices. The third principle I use is to diversify my investments. Personally, in 2025, I've weighted more of my investments to global index funds, so I'm not overly exposed to the US financial markets. A global index fund allows me to spread my money across companies in different sectors and different countries. So instead of buying an index fund just focused, for example, on tech stocks or just focused on the US market, a global index fund is more diversified, and shields from things like a downturn in a particular sector or a recession hitting a particular market. I fully understand that it does reduce the extreme ends on investment returns, so I probably won't wake up and my investment portfolio has increased by 100%. But it also means it's highly unlikely that I wake up and everything is gone. There are lots of different ways that you can diversify your investment portfolio. For example, in government bonds, in funds in different geographies or sectors, or investing in alternative assets and commodities such as gold. I personally have the majority of my portfolio in lower risk investment funds with steady long-term growth as the goal, and then I have 15 to 20% of my portfolio in higher risk assets which has the potential for much larger growth, but also the risk of larger downsides too. The fourth principle is to double down in moments of extreme fear in the stock markets, although my overall strategy is to pound cost average. When we experience market dips and bear markets, I try to double down and increase slightly the amount I invest each week during those moments where there's lots of fear and uncertainty in the financial markets. I'm still sticking to the principle of consistently investing each week, but where financially possible, I up the budget I set to take advantage of large market downturns. The legendary investor Warren Buffett famously stated that investors should be fearful when others are greedy and greedy when others are fearful. And what he means by that is during market downturns, when stock prices drop due to widespread fear, it can be a great opportunity to invest in quality companies at discounted prices. The fifth and final principle is to watch out for fees involved in investing, as it can erode your gains over time. If you're investing in funds, then research the fund management fees before investing, as some of them can be quite high and they'll eat away at your investment returns. There are plenty of low-cost funds to choose from which track the major stock markets, and these are the ones that I tend to go with. The other thing to watch out for is the currency that you buy your investments in, particularly if you're doing short to mid-term investing, as currency values can be very volatile. For example, the dollar value recently decreased by 3.7% against the pound from the beginning of January this year to the beginning of May. So if you purchase stocks or a fund in dollars at the beginning of January and then you try to sell back into pounds at the beginning of May, then even if the stock price hadn't changed, you'd get less money back. I think this is less of a worry if you're investing over the long term, as currency values fluctuate all the time. The key thing here is to understand any FX changes in your investments before selling them. And it goes without saying, make sure you research your investments so you understand what you're getting before buying anything. This video is not investment advice, it's for educational purposes to try to help you in your investment journey. So that wraps up how to navigate investing in 2025 and the 5 key principles that I use when investing. If you found the video helpful, please do subscribe to my channel, give the video a like, and I'll see you on the next video.